Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 190. Well, are you ready to take flight? This week on Friday, SpaceX is going public, in which will be the largest IPO ever. And there is just so much attention put on this thing. So we're going to talk about that. We're going to talk about volatility in the market, beta. We had this jobs report on Friday that freaked everybody out, and we just had the worst day of the year. And so that's across the board. And so we got a lot to get to today on what hopefully will be a good episode. So as always, get your mind right and let's get to work. Well, welcome back to the show, everybody. Another episode here. This is being recorded on June 7th. Man, I'm just thinking it's a 6-7 day. My daughters would, when I said that earlier. Anyways, if you got kids, you know what I'm talking about. All right, so everybody be cool. We got SpaceX going public this week. And there is a lot of interest in this stock. I don't remember the kind of interest like this of a company going public since, I don't know, maybe Uber years ago. And so you look at the market, we're still, everything's up for the year. You have the S&P up 7%, NASDAQ up around a little over 10. You have the Dow up 6. The NASDAQ, though, interesting. Most people you're probably not going to be that much up in your portfolio unless you have a lot of exposure to some of the memory stocks. So if you were to take out some of the memory stocks, Micron, SanDisk, those kind of names, your performance is going to drop dramatically because those are the ones that have been pulling the NASDAQ and really having a dramatic impact on the results this year. Also, Friday, horrible day, worst day in the stock market all year. And when you think about the kind of up-down year we've had, that's actually saying something. Dow was down over, 600 points. NASDAQ was down 1,100 points. And so part of that was the jobs number came out Friday, and the jobs number was good. I mean, there's about 170,000 people that, found jobs included in that number. And you're probably thinking, well, why is people getting jobs bad for the environment, the market, the economy as a whole? Well, think back, the market has been wanting, and, there's been a lot of talk about rate cuts, the Fed cutting rates. Well, if you remember, and we've talked about it before, that the Fed has a dual mandate. So their dual mandate is full employment and price stability. Well, the unemployment rate right now is 4.3%. And with these two good job reports back to back for May and April, I mean, it's looking like the Fed is not going to have the space to cut, which is really bad for kind of the lower, members of the downside of the economy, if you will. So those that really need rates to be lower to be able to buy a house and kind of all of these things when we talk about a K-shaped economy where the people who are doing well are doing fantastic. And if you want to see how well people are doing, this is right in the middle of the NBA finals. Go look at what the price of tickets are for the games in New York this week. And so it really does seem like there's two economies, the haves and the have-nots. And so to get kind of that bottom level of the economy moving, you really need rates to be lower. But based on these numbers, it doesn't really look like that. Plus, you have the other side of this is $100 oil. And if, commodities being high, especially oil being high, usually means that costs go up, costs more to deliver goods. There's all of these input costs that oil goes into where all of a sudden, we thought we were going to get a rate cut. Man, we might actually have inflation. The Fed might actually need to raise rates at some point before they actually lower rates. And so that is, the 1-2 punch, if you will, that was going on in the market on Friday. And we'll see how we we find the balance to that. I'm of the opinion that having people employed is a good thing. It's really, when people are getting a paycheck, they can pay their mortgage, they can pay their car payments. There's all these things that they can do if they, of course, I said make their house payment if they already have one. So it makes it difficult for people who are actually actively saving for a home to get in one if you don't have rates a little lower. So it's just this push-pull, and we've been in it for a while now, this housing trouble we've had for 3 years. And also the big news of this coming week, and the reason I was kind of working on getting an episode out is because you have SpaceX going public. And so part of the reason the NASDAQ sold off is there's probably some money managers out there that are raising cash for this SpaceX IPO, which is going to basically be, if you turn on the TV this week to learn about the stock market or hear about the stock market, you're probably going to see a segment or 3 or 9 a day that are just going to be about SpaceX. So the SpaceX IPO is a big deal. They're looking for a valuation of about $1.75, $1.8 trillion, which is just amazing number to have a company IPO. And when we, really think about this, we're going to have larger IPOs. Anthropic's supposed to go public. OpenAI is supposed to go public. And so these are large companies. And, that money has got to come from somewhere, and it's probably going to come from other stocks that you might own as money managers look to raise money to try to participate in some of these IPOs. And so this could be the first of many times that this happens. And these larger and larger IPOs are kind of a consequence of all the private equity money that's out there. So private equity has done a good job of funding these businesses to where they actually haven't had to go public for a much longer period of time. Years ago when private equity didn't have the reach that it does today, companies would go public a lot earlier because they needed cash. They needed to find that money, and going public was the easiest way to do it. So now we have these 3 gigantic IPOs. And so SpaceX is going to be kind of a, test scenario. But one of the things I want to just caution you with is you don't have to buy, you're going to have plenty of time to buy SpaceX later on. Like, it isn't just like it's only on sale Friday. And if you don't, participate on that day, you're never going to get to own it. And so let's just think back to, all the things we've talked about over the years. And that is the fact that most IPOs at some point underperform and go below that IPO price. Now, SpaceX is supposed to go public at $135. They say that, a lot of these shares are going to be available to retail investors. Maybe that happens. Maybe it doesn't. By the time it starts trading, it'll probably go above 135. And so you just have to, remind yourself that you don't have to invest on day one. And so if we go look at some of the ones we've talked about, over the past couple of years. Last year, we talked about Figma was one that everybody wanted. Well, if you bought Figma on the first day, let's see what the price of that was. It jumped up on the first day of trading to $123 a share, and you can currently buy it for $21. So not great. It's down 74%. CoreWeave was another one where CoreWeave, when they came public, they immediately started trading higher. They actually came public for $41 and went way up to $184 before now they're settled down around $100. And earlier this year when the Iran war broke out, they were at $77. So that was another one. And so now SpaceX at $135. They normally... and I know I've talked about this before, but like normally about 180 days after the company has been trading, the employees can start selling shares. And so that's when I'm thinking about this, I'm always like, okay, well, 180 days later, you're going to have employees that start selling this stock. And so maybe that's going to give me an opportunity to get in. I do want to, just make you aware that SpaceX is going to have a little bit different. They are going to have the 180-day IPO lockup for a lot of the shares for the employees, but they're doing more of a staggered system. And so there's I'm just going to read here, but after they do their Q2 earnings release, insiders can sell up to 20% of their eligible stock after it reports its first earnings. And then if the stock trades 30% or more above the IPO price, so above the 135, if it trades above 30% for 5 out of 10 consecutive days, employees can sell an additional 10% early. And then they have staggered time releases, so they can sell up to 7% of their shares at the 70, 90, 105, 120, and 135 days post IPO. And then they can sell an additional 28% of shares following the Q3 earnings release. Now, I completely understand that you're listening to this at the gym in your car or whatever, and I'm just throwing numbers at you that don't have any representation. But if you have an interest in SpaceX, I mean, go look and see when employees are selling and just kind of be smart about it, right? So, you're probably going to have the opportunity to be able to buy some shares and not have to buy them all on the first day. There is a lot of excitement about SpaceX because it's not just SpaceX. Obviously, they own XAI and they also own Starlink. And so, you have basically these 3 businesses in one. I do think psychologically there's going to be a huge draw to this because there's going to be many investors who felt like they could have invested in Tesla and Elon Musk and they didn't as early as maybe they wish they would have. And so now you're going to get that FOMO, that fear of missing out. And so there's probably going to be many investors who are like, I missed Tesla in the early days. I'm not going to do that with SpaceX. So maybe that'll, put a floor to the stock, and there will be many investors who are like, look, I'm just going to buy it. I'm going to own it, and I'm going to own it over the next couple of years, and I'm going to see what happens. But don't have any qualms about SpaceX. It's going to take a lot of money to get this company where it needs to go. And so they are going to be spending a lot of money over the first couple of years. I mean, last year it's pretty impressive. I mean, the fact that they can reuse that rocket and go up into space. I mean, last year I think they did it 164 times. And so obviously being able to have Starlink and basically provide internet around the world is amazing. I totally get the excitement here. But you also have to be like, okay, well, maybe I buy a little bit, and then when it gets beat up, you just have to, be honest with yourself that this thing is probably not going to trade straight up. Obviously, you have the receipts to this, so if it does, you can, message me. But, in all likelihood, I mean, there normally is going to be a time where that it's going to trade down a little bit. And so just how IPOs work, Goldman Sachs is the leading banker. A couple of years ago, you'll remember me talking about investing in Goldman Sachs and Morgan Stanley because the market wasn't doing a lot of IPOs. And I'm like, this is the perfect time to invest in these investment banks because when these IPOs start coming back around, they're going to get paid a lot of money. And so for these investment banks, these big IPOs, I mean, it's the circus coming to town, and they're going to try to convince you, you got to get into this IPO. You got to get into this IPO. But the problem is right after this one, they're going to be telling you the same thing about Anthropic, and they're going to tell you the same thing about OpenAI. And so, just have a little bit of caution and tell yourself, okay, maybe I buy a couple shares, and then you have to be committed. If it's a company that you want to be invested in, you have to be willing and able, quite frankly, to be able to invest more a little bit later. So don't feel like you're going to miss it. There will be opportunities. We see it all the time. If you go back and look when Facebook, I know they're Meta now, but back then they were Facebook. When you go look at the Facebook IPO, they even traded down after they initially came public. And there is a maturity factor where it takes a little bit for a company to go from being private to being a public company, knowing how to talk to the market, knowing how to report, all of these things. So it is exciting because we haven't had, a couple big IPOs like this to talk about for a while. That 1.75 trillion valuation. I mean, there is a lot of sunshine, rainbows, and lollipops built into that valuation. I will tell you that valuation is like, a total addressable market of space. And, there's all of these, these things. So it is a very, very rich valuation from any kind of metric that you look at. So when Google came public for the first time, they were trading at 10 times sales, and SpaceX is going to be coming public, basically selling at 100 times sales. So think about that as far as, the valuation is very rich, and you have to be careful with that, knowing that, you could be overpaying for this right away. And so take that into consideration. I bring this up because I know that there's a lot of excitement around these IPOs, and it is exciting. There's a lot of cool things that they're working on, stuff that no other company is working on. So I do agree from that standpoint. I understand the excitement. But I thought it would be a good time to talk about beta again when you look at building your portfolio or just portfolios in general. So beta is a measure of the volatility of a stock. So it basically measures how much does this stock swing versus the overall market. So the market has a beta of 1. And when I say the market, again, S&P 500. And so if you have a beta above 1, you would expect the stock to swing or be more volatile than the market. If it has a beta of less than 1, you would expect it to be less volatile. You would have less price movement than the overall market. And so a popular strategy is called a barbell strategy, where you have these fast-growing companies, more volatile companies, and you partner them with some of the old stalwart type companies that don't move as much, are not as volatile. So for example, Micron this year, been a great company, but it's also very volatile. I think it was down 100 points on Friday. Excuse me. But its beta is 2.17. So you would expect that. You would expect to have these wide swings versus Procter & Gamble, who has a beta of 0.38. Now, the way they measure this is they look at it over a 5-year period of time. So they look at every single month. They're looking at, the S&P does what versus your stock. So they measure it every single month to see if the return of the S&P was 1%, your stock was 2%, well, then you're going to be, you're going to have a beta of 0.2 at that point. If the market was up 1% and your stock was up half of 1%, well, then you'd have a beta of 0.5, if you get me. And so they do that every single month for 5 years. And so if you're looking at stocks that are new and they haven't been on the market that long, you will notice that they don't have a beta number because they haven't been trading long enough for that to happen. So my point of this is that it's okay to own these, exciting stocks, fast-growing stocks. But if you don't want the volatility in your portfolio, partner them up with some of the, if you want old, boring companies, the Procter & Gamble's, the AT&T's, those kind of stocks. Coca-Cola, the ones that we discuss. And then that'll bring down the volatility of your portfolio so it won't be bouncing around as much. And maybe you'll be more willing to stick with it. So that can be a strategy, especially if you want to own some of these. So we'll definitely record an episode after we see how SpaceX, how big the fireworks are after that goes public. And hopefully it'll be a good thing for the market. It is a lot of money. That's a lot of money going towards one company. So we really haven't seen what happens when you bring another $1 trillion company to market. And what happens when, they got to put it in the NASDAQ and they got to make room for it. And so I think that's what some of the sell-off was on Friday. And I also think it was that jobs number and taking, rate cuts, basically getting priced out of the market. We'll see what happens because we haven't heard from the new Fed chair, which is Kevin Warsh. So the first time he talks, that will probably also have this. We have the war in Iran. We got all this. There's always something going on in the stock market. It never stops. So let's see what happens with SpaceX. Be patient. You'll have your opportunity to get some if that's a company you're interested in. And as always, don't mistake activity for achievement, and we'll see you next time. Thanks, everybody. This podcast contains general information that may not be suitable for everyone. The information contained here should not be construed as personalized investment advice. There is no guarantee that the views and opinions expressed in this podcast will come to pass. Investing in the stock market involves gains and losses and may not be suitable for all investors. Information presented here is subject to change without notice and should not be considered as a solicitation to buy or sell any security. Ryder Equities does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstances. Past performance is no guarantee of future results.